Access granted.
Hi there. Welcome to Leasing 101 with Group 6. Here are the members of the group. There are Sabrina, Santie, and Whitney. There is also Neilson and Ivan. In this context, we use the Intermediate Accounting Book Source IFRS 3rd edition by Kieso, Weygandt, and Warfield. Now, our learning objectives are: first, we describe the environment related to leasing transactions. Second, we explain the accounting for leases by lessees. Third, we explain the accounting for leases by lessors. And fourth, we discuss the accounting and reporting for special features of lease arrangements. Now let's get started. What is a lease? A lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use specific property, owned by the lessor, for a specified period of time. Up next, there are largest group of leased equipment involves. First, information technology equipment. Second, transportation such as trucks, aircraft, and rail. Third, construction. And fourth, agriculture. There are also advantages of leasing for the lessees. The advantages for lessees are: first, it's 100% financing at fixed rates. Second, protection against obsolescence. Third, flexibility. And fourth, it's less costly financing. Now, how about the advantages for the lessors? The advantages for lessors are: first, it often provides profitable interest margins. Second, it can stimulate sales of a lessor's product. Third, it often provides tax benefits to various parties in the lease. And fourth, it can provide a high residual value to the lessor. Now let's jump onto the second part, and that is lease accounting. Lease accounting conveys the right to control the use of identified property, plant or equipment, an identified asset, for a period of time in exchange for consideration. The various views on capitalization of leases are as follows. First, do not capitalize any leased assets. Second, capitalize leases that are similar to installment purchases. Third, capitalize all long-term leases. And fourth, capitalize firm leases where the penalty for non-performance is substantial. IASB requires lessees to capitalize all leases. Only exceptions: leases covering a term of less than 1 year or a lease of property with a value less than $5,000. Right to use property under the lease is an asset, and lessee's obligation to make payments is a liability. Now for the lessee, they recognizes interest expense on the lease liability using the effective interest method and records depreciation expense on the right-of-use asset. This accounting, finance lease, is applied whether the lease is effectively a purchase of the asset or when the lessee only controls the use of the asset. Now, how about the measurement of the lease liability and lease asset? Well, for the lease term, there are the fixed, non-cancelable term of the lease, and bargain renewal option can extend this period. At the commencement of the lease, the difference between the renewal rental and the expected fair rental must be great enough to make exercise of the option to renew reasonably certain. For the lease payments, there are fixed payments, variable payments that are based on an index or a rate, guaranteed residual value, and payments related to purchase or termination options that the lessee is reasonably certain to exercise. For the discount rates, lessee should compute the present value of the lease payments using the implicit interest rate. This rate, at commencement of a lease, which causes the aggregate present value of the lease payments and unguaranteed residual value to be equal to the fair value of the leased asset. In the event that it is impracticable to determine the implicit rate, the lessee uses its incremental borrowing rate. Now, let's get into the part of lessor accounting. Lessor determines the amount of the rental payment, and not the lessee. For instance, first, lessor determines payment using rate of return, implicit rate. Second, They considers credit standing of lessee. Third, length of the lease. And fourth, the status of the residual value or guaranteed versus unguaranteed. And now, classification of leases by the lessor. For accounting purposes, the lessor classifies leases as a finance lease or an operating lease. For a finance lease, it must be non-cancelable and meet at least one of 5 tests in the next illustration. To meet one of these 5 tests, the lessor must transfer control of a substantial portion of the underlying asset to the lessee or provide ownership of the underlying asset to the lessee. Here is the illustration of the following. You have to meet at least one of 5 tests down below. There are: transfer of ownership test. Second, purchase option test. Third, lease term test. Fourth, present value test. Or fifth, alternative use test. And now, for the transfer of ownership test. If the lease transfers ownership of the asset to the lessee, it is a finance lease. For purchase option test, it means that the lease purchase option allows the lessee to purchase the property for a price that is significantly lower than the underlying asset's expected fair value at the date the option becomes exercisable. For the lease term test. When the lease term is a major part of the remaining economic life of the leased asset, companies should use the finance method. For the guideline, if the lease term is 75% or greater of the economic life of the leased asset, the lease meets the lease term test. Next is present value test. If the present value of the lease payments is reasonably close to the fair value of the asset, the lessee should use the finance method. And for the guideline, if the present value of the lease payments equals or exceeds 90% of the fair value of the asset, then a lessee should use the finance method. Next, we have lease payments. It generally includes fixed payments, variable payments, residual values whether it's guaranteed or not, and payments the lessee is reasonably certain to exercise. And then there is discount rate, which means that the implicit rate should be used to determine the present value of the payments. It is also defined as the discount rate that at commencement of a lease causes the present value of the lease payments and unguaranteed residual value to be equal to the fair value of the leased asset. Now, how about the accounting measurement and presentation? For a sales-type lease, the lessor accounts for the lease in a manner similar to the sale of an asset. The lessor also generally records a lease receivable and eliminates the leased asset as well as the lease receivable is computed as shown. On to the next one. Did you know that there is a special lease accounting problems? Well, there are a couple problems, such as other lease adjustment which contains executory cost, lease prepayments and incentives, and initial direct cost. There is also a presentation, disclosure, and analysis. For the other lease adjustments, executory costs are normal expenses associated with owning a leased asset, such as property insurance and property taxes. Executory costs included in the fixed payments required by the lessor should be included in lease payments for purposes of measuring the lease liability, and payments by the lessee made directly to the taxing authority or insurance provider are considered variable payments and are expensed as incurred. For the lease prepayments and incentives, companies adjust the right-of-use asset for any lease prepayments, lease incentives, and initial direct costs made prior to or at the commencement date. First, lease prepayments made by the lessee increase the right-of-use asset. Second, lease incentive payments made by the lessor to the lessee reduce the right of asset. And third, initial direct costs incurred by the lessee, which will be discussed in the next section, increase the right-of-use asset. Next, initial direct cost. Initial direct costs are incremental costs of a lease that would not have been incurred had the lease not been executed. The examples of costs included and excluded from initial direct costs from the lessee and lessor side is shown on screen in the illustrator below. It is also known that initial direct costs incurred by the lessee are included in the cost of the right-of-use asset but are not recorded as part of the lease liability. Lessor accounting for initial direct costs depends on the type of lease. For operating leases, a lessor defers the initial direct costs and amortizes them as expenses over the term of the lease. And for finance leases, the lessor expenses initial direct costs at lease commencement, in the period in which it recognizes the profit on the sale. For the second problem, we have presentation, disclosure, and analysis. For presentation, the summary is of how the lessee reports the information related to finance and operating leases in the financial statements. So, for the right-of-use asset and lease liability, both of those accounts are reported to the statement of financial position. Whereas for depreciation and interest expense account, they're reported to the income statement. For the presentation, it is the summary of how the lessor reports the information related to sales type and operating leases in the financial statements. Here is shown the illustration of financial statements from the lessor's point of view. And lastly, for disclosure, lessees and lessors must also provide additional qualitative and quantitative disclosures to help financial statement users assess the amount, timing, and uncertainty of future cash flows. Qualitative disclosures to be provided by both lessees and lessors are summarized as shown: nature of its leases, including general description of those lenses, how variable lease payments are determined, existence and terms and conditions for options to extend or terminate the lease and for residual value guarantees, and lastly information about significant assumptions and judgments like discount rates. Now, there are also types of quantitative information that should be disclosed for the lessee that are written inside the box down below. On the other hand, there are also types of quantitative information that should be disclosed for the lessor. Here you can read the info that is inside the box. Now, let's jump onto the analysis. With the increase in the assets and liabilities, a number of financial metrics used to measure the profitability and solvency of companies will change. First, return on assets will decrease. Second, EBITDA, which likely will require some adjustments as companies depreciate right-of-use assets and record interest expense. Third, debt-to-equity ratio will increase and the interest coverage ratio will decrease. After the discussion about leasing before, we will now examine the following example. Here is a simple illustration. On January 1 in 2020, Salim Karya Corp signed a production machine rental contract with Tanu Corporation. The rental period is 5 years from the date of signing with a payment of 55,000 Indonesian rupiahs per year including maintenance costs of 5,000 rupiahs per year, or as an executory cost. The first payment is made at the same time as the date of signing the contract, then it is made every December 31st. The incremental borrowing rate is the same as the implicit interest rate, which is 8%. The estimated economic life of the machine is 10 years. Machine amortization is carried out using the straight-line method. According to the contract agreement, the machine can be purchased after the 5th year at a price of 30,000 rupiahs. So for the questions, we have to, first, calculate the minimum lease payment, second, make a schedule of lease payment, third, make a lessee journal on 2020, and fourth, make a journal if BPO is used. To answer those questions, first of all, we need to count minimum lease payment, which is rental payment plus, rental payment times FOR, 8%, plus, bargain purchase option times PVF5, 8%, which makes the total of the minimum lease payment as 236,023 rupiah. For the second step, we need to make the schedule of lease payment that is based related to the question like the one down below. The schedule that we need to make contains such as, date, description, payment, interest expense, reduction in principal, and lease liability. And so for the last step is making journal on lessee during 2020 and journal if BPO is used. For contract signing, we journalized right-of-use asset on lease liability, and for the first payment, it's lease expense and lease liability on cash. For the second payment, we journalized prepaid executory cost, lease liability, and interest expense on cash. For the amortization, we journalized depreciation expense of right-of-use asset on right-of-use asset. Therefore, if BPO is used, for the last payment, we need to journalize lease liability and interest expense on cash. And lastly, for acquiring equipment, we journalized machine on right-of-use asset with the needed amount. So that's it for today's lesson. Thank you for watching Leasing 101 with Group 6, and we'll see you next time. Bye-bye.